Hi, this is Dan Collins, Editor-in-Chief of Modern Trader Magazine, coming to you live from the floor of the CME Group for Traders Exclusive. Today I want to talk to you a little bit about volatility and what retail traders can do. On Monday, August 24th, the S&P market collapsed. The Dow opened 1,000 points higher. They gained about 80% of the value back on that day before settling back down. Since then, we've seen huge swings in the market, not only in equity indexes, in crude oil, which has dipped down below $40 for the first time in many years, and the last 3 days of August moved 28%. That is scary. If you're a trader, you know, chances are you lost money. Even if you were right on the trades, the volatility has been that strong. It's been up, down, and it's fearful that it could have scared a lot of people out of the market, and rightly so. How can you handle that kind of volatility? Well, one, you have to trade smaller, and it's time that I think most traders have to utilize options. They have to do it for two reasons. One, you know, using the metrics to set standard stops. A lot of these traders in a day would have been stopped out, and the volatility is so strong that it probably wouldn't have been stopped out at their number. So options are a good tool to use as risk management, where you're covered on one end but you're not losing, you know, your opportunity on the other end, where, you know, we joke on the days when I worked on the floor, you know, you call a customer back after a number where the market whipsaws up and then down. It's like you're filled and you're filled. And by the way, your stop is filled at 10 points lower than, you know, worse than where you had it. It's just not a way that a retail trader can work. Now you can trade positionally through options because your risk is set. It could be cheaper, but the one thing you need to know when you're trading options in terms of position is that if you go out of the money, the delta is less, so you're not going to get the same bang for the same move. It's fine. Some trades are great. If you're fearful of a huge market downturn, you don't have a lot of risk capital, you can buy out of the money puts. It could be a lottery trade, but you have to know what it is. You have to know what the market will need to do for that option to make money. You know, I think I noticed before that a long time ago I worked on the floor, and one call I received once a week from a customer was like, hey, I bought these calls, the market moved in my direction, why am I losing money? Who's stealing, who's robbing from me? Well, they were bargain hunting and they bought options that were out of the money, so they lost more through theta, through, you know, the time value, than they gained in their move. So, which is a risk. So know what the delta of your options are, know what you should expect. But in markets like these, it's probably best to use options. The risk is incredible. I looked at a S&P chart, and the average true range on a daily more than doubled from, you know, that August 24th to now, from where it was the whole summer. On a 60-minute chart, it like quadrupled. The movement the volatility is very risky. You have to protect yourselves if you want to maintain these markets. We're in a new world, so you have to trade smaller. Utilize stops for risk management, because if you're trading short term, you're really going to get whipsawed in these markets. This has been Dan Collins, Editor-in-Chief of Modern Trader Magazine for Traders Exclusive. Talk to you next time.